This is a first for me.
Really?
Yeah. Never
This
been
your
on
first
a podcast.
Oh, see, I've been on a podcast.
See, I have not.
We can talk about that too.
I think we're going to talk about whatever.
I have a feeling we are too, yeah.
Well, hey, everybody. Welcome to the first episode of our podcast. Brad.
Hey.
Tell the people who you are, Brad.
My name's Brad Niccum from right here in Indianapolis, Indiana. I own a local mortgage company called Nest Mortgage Group.
Excellent. I'm Brian Quinlan. I am a realtor with Daniels Real Estate, also in Indianapolis, and we are definitely glad that you are here. We are coming to you from Brad's garage, and while this doesn't look like a garage, it's a phenomenal bar.
It is an undisclosed location.
It is an undisclosed
unless you find it on Facebook.
There's a lot of things on Facebook that people can
it's not
find.
really that undisclosed.
No, definitely not. But our goal here, we're going to talk real estate and beverages.
Yeah.
So, cheers to episode number 1, brother.
Cheers to number 1.
All right. So,
that's a good beverage.
Is it?
Yeah.
And you've got something fruity over there.
The tequila and Red Bull, tropical Red Bull.
All right.
Very good.
I don't like tequila. So
you went with the standard.
I have a beer. Coors Light. That's my beer of
Nothing
choice.
fancy.
There's nothing fancy, and maybe it'll get fancier as time goes on. But today we're staying simple with Coors Light. So, goal here: we're talking real estate, we're talking lending, kind of give you an update on what's going on in local market, world, whatever. We're gonna talk beverages, and honestly, hopefully, just have a good time. Having a good time definitely means talking interest rates, Brad.
Oh yeah, interest rates right now it's nothing but fun. Right? They're not double digits. That's a bonus.
We're going to take that as a bonus.
Yeah,
though
that's a bonus.
Anybody watching this has probably never experienced double-digit interest rates.
No, I mean, you have to be old.
You would have to be older than us.
Yeah.
Though I don't recall my first interest rate, which would have been back in the late 90s. I don't recall paying double digits for interest rates even back then.
Then when I got in the industry in 1997, 8.5. That's where interest rates were. And I was doing a lot of refinances and refinancing a lot of customers out of their 12s.
Woo.
And they made comments like, this is like free money. This is amazing to have an interest rate that's a single digit. And that got erased when we got down to the 2s.
Well,
right?
I can tell you, back in 2021 when it was 3.5%, 4%, I heard people saying, it's like free money.
It's like credit card money.
And that's what's throwing things off so much is because, old people like us talk about the old days of interest rates. No one cares.
Right.
It's what is it now and what do they remember most recently? And most recently is interest rates down in 3.5% to 4% range. Now it's double that or more. And it seems like an astronomical amount, but it's not.
Right. Yeah, it's really kind of normalized if you think about a 20-year or 25-year history of mortgages. We're talking about the 10-year treasury is the highest it's been in 23 years, and that puts interest rates back to where they were 2000 and before, so back into the 7s. And if you look historically, we didn't see interest rates below 7% until the late the 2008, 2007. That's when interest rates really started to fall into those 6s and 5s and the 4s after 2008 for a little while. And, it comes down to a couple of things. They always talk about interest rates are low when the economy is slow, right? So if the economy is bad, interest rates are low. And if you look at population growth, a lot of people have been talking about what's going to happen with housing in the future and why we're not going to have another 2008. And if you look at the population of, I think I'm a Generation X, we're a really small group, right?
For real.
1974, lowest birth rate in 25 years, down to 1.7 million. And if you think the average person buys a house at 33, well, 33 years later, that's 2008.
Yep.
So, okay, boom, we had a slowdown. And then 74 all the way through 86, 1.7 to 1.9 million people born. So we had a really small generation. And then 1987, we jumped to over 3 million people born. That's 2021 for you 33-year-olds, right? And now we have a housing shortage. And if you think about the growth in the economy, when you have such a growth in population, the economy is not going to be going slow. It's going fast like it is now. And interest rates are always higher when those times are going faster. Kind of like when the baby boomers were all coming of age in the 80s. Housing was crazy. A lot of people bought homes in the
Yep.
80s, but interest rates were high, double digits, right? We had double-digit interest rates all through the 80s and the 90s. So,
And they still bought houses?
well, yeah. I mean, think about it. A 3-bedroom home in 1983 was like really crazy expensive, like $45,000.
Whoa, with a 21% interest rate.
Right. Their payment was almost the same as the ones today. So yeah, it's kind of neat to look at history and think about where things could be, not only with that growth in housing, but really the growth in all markets. I mean, think of all of the kids that are graduating college, heading into those jobs where they're first going to enter into their 401ks and IRAs and so much more money into the market. Again, the 80s were a decade of excess because there was so much growth of baby boomers.
The 80s was awesome.
The 80s was awesome. Yeah, I totally agree. If we could back, man, Poison and Van Halen.
Right?
Ah,
Bon Jovi.
Bon Jovi.
Let's go.
Yeah, those. I don't
So
know.
anyway, interest rates are really what's killing my world in real estate. With interest rates being so high, obviously buyers are reluctant to want to throw money at a house. That's because they knew that there was 3.5% and 4% interest rates, so now they think they're paying some outrageous amount of money.
Yep.
I don't know about you, but what I tell people who are reluctant is to talk to a lender, because it doesn't matter what the interest rate is. It's all about, can you afford the payment on a monthly basis?
True.
If the interest rate is 7.5%, but it's a payment that you can reasonably afford on a monthly basis, who cares?
Right.
If it's possible to refinance later, and that's not the case for everybody.
Right.
But if it is, then that's a bonus for you. But if you lock it into a fixed rate at what it is now with something you can afford, you're good until something changes, and if it goes up, you're locked in. So not a big deal.
Especially if you're a renter, right?
Yeah.
I have all these renters go, interest rates are above 4%. I want to buy a house, and okay, well, you're renting, so your rate's it's 100%.
Yeah.
Right. And I had a customer recently said, I've rented this house for $800 a month, and I could have never bought a house like this for $800 a month. And he had been there for 10 years.
Wow.
And as we talked through it, I said, well, let's see, 10 years ago, the house you live in was probably $120,000. Lives out by the Terre Haute area, right? So $120,000 for this house. If he would have bought it, he would have had a payment 10 years ago, well below that $800 a month payment that he had. He's paid that payment for all of those years. He would have that house more than halfway paid off. Now remember that houses have grown in value so much over 10 years. In fact, if you look at that house and look up the address, the house is probably worth $270 today. His $800 a month payment cost him $300,000.
Yeah.
Right? So when you start thinking about that, okay, today, let's buy a house today. And all of the forecasters are talking about what housing prices are doing. They're all going up. They're going to continue to go up for quite some time. Case-Shiller just came out with their report on Monday. Month over month, the United States housing prices went up 0.6%. Right? So if you take 0.6% month over month over month over month, we've got great value growth in homes.
Absolutely.
So you could buy a house today, say for $300,000, and if we do that 10% growth that they're really forecasting that we're going to have, wait to buy the house for rates to come down and buy the $300,000 house next year for $330,000.
Yep.
Right? You gave up the $30,000. And when you look at where rents are, you posted a report not too long ago that I think we were second or third for the fastest growing rents in the United States as a metropolis, right?
Yeah.
So, okay, quit renting and buy a house. I mean, it just makes sense. The house is always going to be worth more than what it was when you bought it.
Sure. One of the things that I had just put on my Instagram recently, just in the last couple of days, was, as a realtor, of course, I want people to buy houses.
Sure.
As a lender, you want to loan people money to buy houses. I don't want to make it seem like that's the case for everybody,
Sure.
And it's not, because, some of the things you have to consider when you're thinking about buying a house is how long you intend to be there.
Right.
Because if you have a job that is fluid, so potentially you could be transferred within the next year to some other state, some other location, maybe you're even in the military or, whatever. If you're not sure that you're going to be in this career or in this location for more than, I would say, 2 years, buying a house probably isn't right for you.
Right.
In addition, yes, we talk about getting it now because it's cheaper, and a year from now it's going to be more expensive because it's going to go up. But realistically, not everybody can afford where it is now. You're not going to be able to afford it next year either, potentially. But I mean, if you can't afford it now, don't throw yourself into a situation where you are strapped for money, because every month all of your money goes towards the house and then you can't do anything else. Obviously we want people to buy houses. It is the best way for you to build wealth over time. Renting is not.
Right.
But it's not for everybody, and I don't want anybody to feel like we are pressuring anyone to go buy a house, because it isn't for everyone. But the best thing you can do is, if you're considering it, is to talk to somebody. Talk to a realtor, talk to a lender, to find out for sure. Because
everybody knows you have 3 credit scores, right? Experian, TransUnion, Equifax.
Okay.
Those are your 3 credit bureaus that issue a credit score. But you have multiple scores at each one of those places. You have a mortgage score, an auto score. You have a credit card score, a revolving card score, a bank card score. You have a utility score, an insurance score. And Credit Karma.
I did not know that until I got into this line.
A lot of people don't know that.
No idea.
Yeah, and a lot of people don't know that Credit Karma, although it's a great service, to give you an idea of what's happening with your credit, right? If you wake up one day and you got 800 credit scores and Credit Karma says you have a 650, something happened to your credit, right? So I just had a customer have a horrible thing happen to their credit, and we're working very hard to get it fixed before they close on a loan. But Credit Karma is actually taking all of the information it can find about your credit, putting it into an algorithm, and telling you what it thinks all of your scores may be. And one of the things that I just found out recently is that your credit score for a car is a higher credit score than all of your other scores. So a credit score goes to 850, right? Everybody knows that. Except for the car score. The auto score goes to like 950.
What?
Yeah, they have a different way of calculating your credit worthiness for purchasing a car. So your auto score is in part of those calculations, and if your auto score is higher, it's going to trend your Credit Karma score higher than what your score is.
Raise it up.
If you have CreditWise that shows up in some of your credit cards, I know you're not a credit card guy, but I think CreditWise shows up maybe on your Discover card or your some of your bank cards. That's actually looking at your bank card score, which is your revolving credit score. So it's actually looking at a different score too. So when you call to do the mortgage, you're saying, oh, my Credit Karma says I'm an 810, and I say, well, you got a 684. And here's something that happened the other day. So I had a customer call. They wanted to get pre-approved. They told me their credit was only a 460. And unfortunately, when you have a 460,
you're not doing much with that.
So I told them, your minimum credit score for an FHA loan for 3.5% down is usually 580 or above. And the wife yelled from the background, I have a 432. Can't you just add them together? And no,
you cannot.
My life would be so easy if I could add people's credit scores together. Like, this is a great deal. They have a 974. Woo! But no, it doesn't work that way, unfortunately. We always throw out the high score, throw out the low score, have to go with the middle score. Okay?
Like the Olympics.
And also, if you have 2 borrowers on the loan, you're going to take the lowest middle credit score of the 2 borrowers. If you have 4 borrowers on a loan, you're going to take the lowest middle credit score of the lowest borrower. So that's why sometimes when you look at a deal, you say things like, hey, let's take this spouse off the loan because you qualify on your own and I can get you a better interest rate with just your score. So that's sometimes why you might be getting that advice. And scores can be crazy across the board.
Yeah, for sure. So one of the things that I'm finding, and this is actually referencing an article that I'm looking at here from Redfin, that home sellers are now starting to almost have to drop their prices because homes are sitting on the market for longer. So reason for that being buyers are fewer buyers, though there are still more buyers than sellers. But buyers are being more picky because they can.
Yep, they switched it up.
Absolutely. And so sellers are finding that, the days of listing your house at whatever price they wanted to maximize what they can get out of it. Of course, that's a great idea in theory, but they have to be more make a better choice when listing the price of their house. Listen to their realtor for advice. Always get advice. But You know, I have a particular case right now where one of my sellers, their house has been on the market for a month and has had hardly any activity at all. And so we're talking about the possibility of, do we need to lower the price? Because it's just not attractive to buyers when this house is priced higher than others in the neighborhood. And they start to look more specifically at that. Why is this one, you know, does it have nicer countertops, nicer floors?
Right.
You know, what kind of upgrades are going on in this particular house? And if those things aren't there, then the buyers are now have the ability to be picky about it and say, well, I'm not going to pay more for this house when they don't have the upgrades that this one over here does. And so they also are exercising, I think buyers are being more patient, because, you know, they're hoping interest rates are going to come down because there's so many people out there spouting, oh, rates will eventually come down, and
Eventually
they hope it's going to be next week. But, you know, that is something I'm finding, is that sellers are now realizing, holy cow, we're going to have to start making this more enticing for buyers, whether it's making concessions on the deal, such as paying down some of the interest rate. We're going to talk about that.
Fixing actual things that need repaired.
Paying down some points, actually fixing things that need to be repaired. And that's actually one of the things that I've done. I have a seller coming up here in the next week or two. They actually inherited the house from a parent that had passed away. And so they're like, we need to get this house ready to sell. And so I walked over there, gave them an idea as I walked through, and I said, what do you think about the possibility of doing a home inspection here before you list the house?
Sure.
And that's not something that often comes up. But and they even came back to me and said, isn't that something that the buyer does? And I said, well, yes, but consider this. If you have the home inspection, you're going to see what needs to be fixed. I can talk to you about what it is a buyer is most likely going to ask to be repaired. If you get those things fixed now, it's cheaper than if you wait for it later on, because you may know a handyman, you may have a cousin, a brother, a good friend who works for an HVAC company that can come in and do a side job and cost a lot less and is still a professional doing it. And then when you list the house, you can rely on that likely not showing up in an inspection, that the buyer is still going to have an inspection. But, you know, you've already addressed it. Whereas if you wait till later, then the buyer is going to come back and say, we want you to fix the HVAC with a licensed contractor. And that's always going to cost you more money because you're paying for the professional, which is someone who should do it, don't get me wrong. But it just is more costly that way. And so
take away this last couple of years of crazy market, though. A seller's buying inspection or a seller's inspection before the house was listed was a fairly normal thing.
Not that I've ever experienced, but again, I started real estate in 2020. So even like,
go back to 16, 17, that was a thing. If you were going to list your house, go ahead and get an inspection done. Find out what the issues potentially could be, which ones you were probably going to negotiate, which ones you were going to fix. Yeah. And that was a thing back in the day.
And, you know, that's, it's, sellers forget that, I suppose.
Sure. You know, just like buyers think interest rates are supposed to be 3%.
Exactly.
You know, one of the things that I'm hearing over and over again, if you have a house that, let's say you're going to list it, it's worth $425, okay? And you, as the seller, really think, you know, other homes in my neighborhood have sold for $430, so I want to list it for $430. Once you list it for that price that's too high and it sits on the market for 30 days, you're kind of done, right?
Yep, absolutely.
But what a lot of realtors that I work with have been doing a lot of is, hey, we're going to list your house for $400. And we're going to list it on Wednesday. That's when we're going to make it go live. We're going to take offers until Sunday. We're going to have an open house on Saturday. And they create that, you know, excitement and those multiple offer situations. And when they get to Sunday, the highest and best is $425, maybe even $430. Now, I know that's not happening in all communities, but if you're in Fishers, Carmel, Westfield, Zionsville, Brownsburg, some areas in Plainfield, there's still a lot of people trying to buy those 300, really 250 to 600, right? It's still a crazy market. And if you come in high, if your expectation is to be high and you miss the mark, you're going to sit on the market and you're going to reduce, and someone's going to think something was wrong with it and you're not going to hit. But if you come into that first 5 to 10 days with a lot of excitement, now that multiple offer situation can drive your house up to that higher value.
Yep. And, you know, if it sits there for too long, like you said, you're going to have to drop the price, number one. Number two, the buyers start to think, what's wrong with this house? Why is it still sitting here after 30 days? So not only are you going to drop the price, but the buyer is likely going to offer you less than what you dropped it to.
And pick.
Oh,
they're going to be picky through the whole thing.
Much more nitpicky. And so, pricing strategy is really a key thing right now.
Big time.
If you want to get it sold quickly, and I mean, if you're putting it on the market, I would assume you want to get it sold quickly.
Yeah. You want to, unless you're going to overprice it, just let it sit there. Like I could list mine for sale, and I have a number in mind, and it would be for sale for a couple of years, and no one would ever buy it. But hey, I would have this excitement that I listed it for that.
Yeah, that's right. That's actually, sadly, the client that I have, they have a number in mind.
Yeah,
so
people do.
It's just sitting there. But all I can do is all I can do.
You brought up buy downs. A lot of people are
yes.
asking questions about buy downs. I get we want to do a 3-2-1 buy down and offer that as a seller, right? Well, when I hear that, I go, well, you listed your house at too high of a price and you're at that 30-day window where no one's looking at it, and you want to give up $12,000 to pay for somebody's buy down because you think that's going to entice them to buy the house. And a lot of times, just lower the house price $12,000. These 3-2-1 buy downs and 2-1 buy downs, they used to be a great product back in the day, right? In the 90s and in the late 2000s, early 2000s, before they went away after 2008, a 3-2-1 buy down, a 2-1 buy down, they were funded by the lender, right? So when that rate was 7.5, and you're going to start at 5.5, go 6.5, and then 7.5, the lender funded or that subsidy to buy that rate down. You maybe paid 2 points and you started at the lower rate. And the advantage to them was when you didn't debt ratio for the house at 7.5, back then the debt ratio was done off the start rate.
What is that?
You debt ratioed off the 5.5 payment, not the 7.5 payment. One of the reasons they went away, because after they went up, people couldn't make their payments, right? So in today's world, the lender's not subsidizing the buy down. Your seller is. So you're giving them $12,000 to give you back $12,000 and a lower payment in year one and a little bit lower payment in year two and the normal payment in year three. Where really, you're just financing more money to temporarily subsidize a lower payment, that if you can just afford the payment of what you're going to buy anyway, buy it for $12,000 less. Lower your payment until you can refinance.
And keep the interest rate out.
Keep the interest rate is what it is. And a lot of people not doing that math. And it's truly
math is hard.
Well, it is for people without fancy calculators, right? I had one in Florida. The buy down enticed them to buy the house. When we did the math, they're like, can we just apply that money towards a normal buy down? Yeah. And we just lowered their rate and did it towards a normal buy down because they already had it in their deal. It's not like we could renegotiate it out at that point. But once you do the math, you find out, well, maybe that gimmick isn't that great. Because usually whenever you hear something that's thrown around in social media and thrown around in marketing, there's a lot of gimmicks to marketing. It's how people call. Kind of give me a shot. That's a gimmick, right?
So it is.
You get a shot, though. Not of tequila, because he doesn't like it.
No, tequila is not good. People say that tequila is not good because they've had bad experiences with tequila. I just don't like the taste of it.
Well, bad experiences come from childhood tequila.
Okay. There are bad
over the
tequilas.
ages of 21.
There are bad tequilas that
when you
up.
go up to the top shelf tequila up there, that stuff is good stuff.
All right, you say so.
It's kind of like the difference between bad whiskey and good whiskey, right?
I suppose. I don't know that my tastes are that refined in any way, shape, or form.
Your headaches will be. The cheaper the whiskey, the worse the headache.
There you go. That's a good point.
Yeah.
So, little background on you. You've been doing this for how long?
Got in the mortgage business in 1997.
Ooh, okay.
Yeah, so
like
long time ago.
Lending, mortgage, is that all you've ever done?
No, actually, so we built a mortgage company and sold it in 2006. Mortgage Express was our first company, and then I actually started another business and was in the landscape and snow removal industry for a short period of time.
Got you to the Super Bowl. That's a story for another time.
The only thing that came out of the snow removal business that was good was I did get to work with the Super Bowl, but the rest of it.
So you started a mortgage company, then you went landscaping company and sold that.
and got back into the mortgage business. Yeah. So
was it back directly into Nest from there?
Correct. Yeah. So my original business partner, when he stayed in the business when we got out of the business, he pushed through 2008 and made it work. And when the business started to come back around, he and I were yin and yang to each other. He's really awesome at the operations side, and I'm a marketing guy. So the two of us worked really well together. So he's like, hey, I'm tired of doing this on my own. Let's do it again. Would you please come back? And 2014 was when I really contemplated jumping back in, and then took me a couple years to get out of the business I was in to jump back in.
Okay.
And I absolutely love it. I will do this till I die. Maybe not to the level I do it now.
Sure.
But until I die, I'll be putting loans in the pipeline and closing deals.
Okay. Good deal.
So, yeah.
How many? So, okay, we'll go to me, I guess. So, out of college at Indiana University.
So you went to college?
I did.
Yeah, I didn't go to college.
I have 3 college degrees, and first one was sports broadcasting, which
you utilize.
Well, to a certain extent, I do. We'll get to that. But my first job was Blockbuster Video. Back in the late 90s. I started as an assistant manager, worked my way up to store manager, and believe it or not, Blockbuster had the opportunity to go into business with Netflix
and didn't do it.
No,
I know.
And that is a famous history lesson right
Aren't
there.
you glad you didn't buy stock in Blockbuster?
They decided to partner with DirecTV instead. That did not go well for them. Anyways, so nearing the end of my Blockbuster career, I went and got my second degree, which ended up being elementary education, and got a job teaching second grade in Center Grove, and did teaching for the next 20 years, which the first 8 was elementary school. Did second grade, then third grade, then fourth grade. And I did so well that last year of fourth grade, I skipped fifth grade and went over to sixth grade.
Wow.
And did my last 12 years of service as a sixth grade math teacher, still in Center Grove. And that's where the sports broadcasting came back in. By the way, in there I also got a master's degree from IUPUI in educational technology. So that's the third degree. I'll go back there. The PA announcing became a thing for me, only because I liked kind of talking on a microphone. My first year at middle school, there were football games at our school, and they were like, hey, you want to come and do the PA announcing? I'm like, well, I've never done that before.
Sure. So
I went and I watched the dude who was doing it, and I was like, yeah, I can do this. So signed up to be the PA announcer, and basically became the full-time PA announcer for the middle school football team. We don't do much PA announcing for other things, but occasionally there'd be like a big basketball game, and I'd come in and PA announce that. And so that continued steady for 12 years. I did a little coaching here and there. 2019, I passed my real estate exam because I decided I didn't really want to teach anymore. Just wasn't really feeling it. I enjoyed being around the students because they're fun. The sixth graders I found were kind of my people.
They're not mine.
I liked the people that I worked with, but I didn't like the job of teaching anymore.
Sure.
The lesson planning, the grading papers,
the getting the summer off.
Not a thing. And, meetings that I oftentimes didn't feel were particularly worthwhile. So I was like, you know what? I was in a financial position where I was able to leave teaching and go and do something that is randomly paid.
That is true.
We don't get paid till the closing table. So my wife, great support person, and she's like, yeah, go ahead and do that, and we'll see how it goes. I was like, worst case scenario is I'll go work at Amazon or, something like that. Teaching. No, I will not go back to teaching. Though I could. I've been asked multiple times. Could. I absolutely always could. But I don't anticipate that. But I have stayed in touch at Center Grove because now I've become the PA announcer for the high school football team. Yeah. And they've been the state champs for the last 3 years, and I've been the PA announcer for 2 of those. I did a softball season the year they won the state championship.
Nice.
And now I'm also the boys basketball PA announcer. Okay, so anyways, I got out of teaching. Went into real estate, signed with Keller Williams. Yep. Which is actually how you and I met.
Right.
Did 3 years at Keller Williams, and it was a great experience. Worked with a great team. And then this year decided it was time for me to, branch out and try another avenue. So I joined Daniel's Real Estate, which is who I'm with now. And it's been a wonderful experience. And, I've had some great connections with lenders like yourself and others. And
sure, we're going to get rid of them others.
It is a people business for sure.
For sure.
I find that, and I find myself continually saying this, first-time home buyers are they're my jam.
It's mine too.
Because that is absolutely my teaching roots right there.
Absolutely.
I love sitting down with first-time home buyers and just talking about, okay, I'm going to lay out all of this for you and tell you what you can expect to get into.
Yep.
And, it may take 45 minutes to an hour, depending on how much I talk. But I oftentimes at the end, do you have any questions? And they're like, wow, you've answered everything we could possibly have asked. And so, and then, the fun starts. You have to actually go look at houses, and negotiating. I don't necessarily love that part, but, it's just part of the business. And, my goal is always just to do the best I can for my client to get them the best deal, and whether I'm the buyer or the seller person. But, there is a lot of what I did as a teacher that comes over into being a real estate agent, and it's been a good mix.
Yeah, I get that completely, because the first-time home buyers, so many people are afraid of this process on the mortgage side. And I do jokingly tell people that I give them a fiscal colonoscopy, right? You can't hide anything from the mortgage guy. We find it all.
Anything with the word colonoscopy in it just seems unpleasant.
And if you can put the word fiscal in front of it,
sounds worse.
Sounds worse. But I've always said it this way: if you walk into a dark room, it's scary, right? You might stub your toe on something or fall into a pit and have to put the lotion on the skin. So those dark rooms can be really scary. But I always say,
reference for those of you that missed that.
In the mortgage world, I flip the light on to the dark room. I turn the lights on to the process. I explain why and how and what. And if you understand the why I'm asking for something, the why behind the question, you understand it. You feel more comfortable in getting that information or walking through that process. And it's something I found first-time home buyers. I'll hang up the phone call and I'll be on the phone for an hour. Do you have any questions? They're like, no, wow. I know what to do next. That's kind of the best part.
And, that's why I like working with you. And like I said, I do have some other lender partners. But I will only refer people to lenders that I know are really good explainers, because so many people don't know enough about finances. And especially if they've never bought a home before, have no idea what they're about to get into. They think their credit score is 670 and it's really 600
or 740
or 740.
They don't even know.
So you just never know. But they just don't know what they don't know. And so a person like yourself, who does a great job of explaining and making sure that they understand it before you get off the phone, and on top of that, if they have questions, you're available later. I know, because we've had this discussion before, you will answer a call in Cabo.
Absolutely. Actually, it's so we just went to Costa Rica. My wife and my son and his daughter wanted to go to Costa Rica.
You FaceTimed me from Costa Rica.
I did. And so I'm not an excursion kind of guy. What I like to do is the mortgage business, even from really awesome locations.
While having beverages.
Yeah. So, my setup when we go to Cabo, we've been doing this trip for literally 20 years. Sammy Haggar's birthday party. Woo! He's an old rock and roller. And when we get there, the first thing I do is I get my laptop set up, and I got to deal with the hotel so I can print. I've got a great Wi-Fi package there, and I don't miss a beat. And people don't know that I'm not here.
So on our next episode, which we're probably going to do while you're in Cabo, can you get Sammy Haggar to make an appearance?
No, I cannot. I have met him a couple times. That's about all. So
that's disappointing.
But, I'll be a few feet from him, I'm sure, like a couple thousand. I think there's a restraining order.
If you made it this far in the episode, thank you for watching. We appreciate you sticking around with us, and we hope you come back next time.
And make a comment and your email address, and I'll send you some info, and then I will send you a free give me a shot glass.
Great idea. And if you need, in the Indianapolis area, lending questions answered, real estate assistance, drop us a comment and we will reach out to you.